All right, everybody, welcome back. Welcome back to the channel. Matt Money back in action. And yes, I sold it all. I sold all my dividends. I sold Jepi. I sold Pepsi. I sold Johnson. No, I'm just kidding. I'm being a little bit facetious. But you guys know for a fact that I'm slowly transitioning out of more of my dividend specific portfolio that you guys may have seen me kind of growing up on when I was growing from 100,000, 200,000, several hundred thousand, now to the point where it's large, to more of just a long-term solid growth portfolio. Now I think a lot of this has turned some of you guys off. The reason being is you guys are sitting there viewing it from a lens of, hey, I want to grow my dividends. Dividends are the only thing that matter to me. Oh, by the way, I got a new TV. Don't mind the box in the background. The green screen still works. Just, we're good. Okay, just give me a second. But today I just want to walk through it, right? I keep iterating this point. I think some of you guys 5-10 years down the road are going to slowly realize that you missed the boat. You've missed out on hundreds of thousands of dollars of potential growth, just like I realized I have over the past 10 years by investing in high dividends, high yielding positions, right? And so I want to take some of the sweethearts, and I'm not saying it's a bad thing, right? It's personal finance for a reason. You have to recognize what is personal to you. And some people might, out of ignorance, like I did, I will be blunt, like I did out of ignorance and blindness and short-sightedness, was specifically only looking at dividend income quarter to quarter and saying whatever I can do to get that income number up. So I was investing in the Altria groups. I was investing in these high yielding, very early on. Then I slowly realized, hey, there's a sweet spot, right? Between 1.5% yielders to 3.5%. And I'm not saying every company that yields between that's great. I'm not saying some of the companies that yield zero are better than others. I'm not saying that there's not a great company out there that yields 4.5-5%. I'm not saying that. But I'm saying if you look at that little sweet spot, you're going to find great companies that are doing greatness in terms of reinvesting back into themselves, that are not necessarily focused on sucking all the resources out of the company through dividends and buybacks. They're continuing to innovate. They're not as mature as some of these other companies that are yielding 7, 8, 9, 10%. And so I just want to take a quick look, another perspective, and hopefully this helps you guys out a little bit to see, am I being short-sighted? Am I looking for 5-10% yields right now because I think that that's the only way to go? And what I'm telling you is from experience, some guy that started with a position of $0,000 or $0 rather in 2012, 2013, and has since, had a decent income job, saved over the past 10 years, a decent amount, 30, 20 to 30, 40, sometimes 50% of my income, depending on some years. And has basically realized that I would have probably 20-30% more money if I just invest in the S&P 500, maybe more. And it's an opportunity for you guys to learn from where I messed up over the past 10 years. So let's just take a quick look at something that I think is near and dear to everybody's heart, which is some great high yielding dividend sort of stocks that I thought, what the heck is going on here? I think the back screen disappeared. Give me a sec. What happened? What happened? What did I do? Okay. I don't know what happened with this. We're fixing it. I'm sorry. So yeah, we're wheeling down. We're going to show you guys the actual favorites. We're talking about Divo. We're talking about SPY. We're talking about Jepi. And we're talking about VYM. And then there's another one that I want to mention in here, which actually has done relatively well. But you can see the short-term volatility, right? VYM and Amplify, which is Divo, have done actually pretty well over the past year. We know in the beginning of 2022, it started to really go downhill. The market kind of peaked for most cases, and we kind of saw this steady trajectory towards the end of last year. And we did have a little bit of a rally towards the fourth quarter and in November, beginning of December timeframe, and we've kind of started to sell off a little bit again. But since then, you've seen things perform rather well in terms of some of these Divos and VYMs of the world being able to hold up during this volatility. Now, what I do want to highlight, VYM has like a 2.5 to 3% yield, if I remember correctly. Divo has something like 5 to 6%. Jepi has something on the order of at least 7%, right? And the reason why I'm saying this is in volatile times, or times that it's rather flat, you know, it doesn't really matter so much comparatively to when you're looking 5 years out and the difference between what I'm going to explain to you. So in very flat times, in volatile times, when the market isn't growing expansively, you will see that the things like the Divos of the world, Jepis, VYMs of the world are okay. They match up pretty well, like we just kind of saw the last year with the S&P 500. Granted, some of them are tracking 5% less or more than the others. But where they really truly start to deviate, and you can see this very heavily in 2020, is in the growth times. And so if you think about it, if you're staying rather flat, or in sort of the same sort of vicinity in terms of growth or lack of growth, whatever you want to perceive it as, in a bad year, volatile year, and then over time, you're kind of looking at, hey, we're doing really, really well in the SPY or these other growth opportunities or balanced opportunities in the really great years. Over time, these things are going to deviate pretty expansively. Now, I can't hit this max button. Well, I can, but you'll see not everything goes back to when SPY really started tracking, which was 93. So it really doesn't do it all that much justice. But what I'm trying to share with you is yes, 42% yield, 42% return over the past 5 years on SPY. VYM has done 20%, which is great. Amplify, Divo, basically 19, and then Jepi, which only really started in 2020, so you can't really count that 100%. Only 5% return. But you can see, they all kind of in the 2020 time frame kind of started around the same flat area, and how they really started to deviate in that time period. I know that Jepi doesn't go all the way back to 2018, but what I'm basically trying to share with you guys is, are you blind to the fact that yes, you might be getting your yield, and if you're having it in a sheltered account like a Roth IRA or anything like that, it might be a little bit better. But if you're just having it in a taxable brokerage or something of the like, you're gonna have to be paying, pretty high yields on that, right? Or pretty high taxes on that. And depending on what tax bracket you are in, it's 20%, 40% hit. So that 5% yield is now only really 4%, 3% yield. And so you're giving away, 20 to 40% of your growth in some of those times. And I'm not to say that if you're close to retirement or something like that, then, this is a completely different conversation. But if you're like myself, who's in his prime earning years and has still, say, 10, 20 years to go, do you really want to set yourself up where, hey, we're about to have a rebound? I anticipate we might go down a little bit from here, but I anticipate the second half of 23, early 2024, we'll see a decent rebound when the Fed really starts to pivot. And with that, I think that you'll see that things will start to truly find their footing. Earnings will come back in the S&P 500, and things will turn around to go towards the growth cycle again as interest rates no longer have a strangle on the economy. And will you want to be in those high-yielding, dividend-paying stocks or those option ETFs that pay you every month? It's truly up to you. But I think in a span of 5 to 10 years, where do you think your money is best suited? Now, like I said, if you're close to retirement, maybe those income ETFs are more up your alley, right? But it really is dependent upon where you are in your cycle. What I realized was I underperformed the first 10 years of my life, being in the high income funds of the world, the Exxon Mobils of the world. And yes, you could swing trade Exxon Mobil and do really well. I did as well. But very early in my career, I was buying Exxon Mobil when it was $80, $90 and basically sold it for break even until I bought back in, 2019, 2020, whenever things really started to get bad again. And I'm now since out of it again. But I was investing in it when it was just hanging out flat, and I was just collecting a 3% dividend yield. And if sometimes the growth was anemic, as you'll see in some of these high yielding companies. And so you really have to pay attention, and you can't just blindly follow people. This dividend mantra of things is truly getting to a place where people are just looking for the yield and not really thinking twice about their long-term benefits of investing in something that's actually investable versus, and I'm not saying all dividend companies do this, but that are only focused on being led by the BlackRocks, the State Streets, the Vanguards of the world saying we need our dividends and we need our buybacks now. And that's not allowing them to reinvest back into the business, continue to grow into new industries and stuff of the like, as they're starving the businesses themselves. So the share price goes down, the dividend yield goes up, you're continuing to invest more and more, it'll come back, yada, yada, yada. Consumer trends change. Nobody's buying this thing anymore because consumer trends changed. The company never invested back into themselves, so they can't follow along with it. The business dies. Think GE, think a lot of these other businesses. That this is bound to happen to, and that's just life. That's just capitalism. But I think what you need to recognize is the S&P 500 is ever changing. It makes sure that you're a profitable organization. The yield's 1.5% to 2%. So in all reality, it's not that bad of a deal. You're getting that 1.5%, 2% drip, if that's something that really matters to you, and you're getting steady growth. And some of you guys might say, okay, well, if we go back to this graphic that I was kind of sharing, there's yield and stuff in there, yes, but you're paying taxes on some of that yield. Is it really the difference between 5% and 2.5% or 5% and 1.5%? Is it really going to make up the difference? It might be flat, but keep in mind, you might have to pay taxes on some of that stuff. So it is tough. One thing that is very surprising, though, this is why I kept this off, is SCHD has done extremely, extremely well. So Schwab's dividend fund has done really, really well. Now, is that an indicator of future performance? I have no idea, right? And you can never say that. But I'm just very surprised that in this case, SCHD has done dramatically better than I would have expected comparatively. It did lag a little bit in the 2020 to early 2021 timeframe, but it really caught up in the mid 2021 timeframe. And now it's kind of started to get flat again in the 2022 to 2023%, not 2023%, 2023 timeframe. But anyway, wanted to share that with you guys. I have quite a few discussions with folks on Twitter and whatnot. And, I see some of these folks, I want to say, making the wrong decisions about their investment career, right? And, I think some people try to venture into dividends way too early. I think they need to focus on the growth of their portfolio. $50,000 worth of dividends really isn't gonna, like, when I mean $50,000 portfolio yielding, let's just say $3,000 to $4,000 isn't great. It's a starter position. It might help pay some bills, stuff like that. But if you could pay those bills out of your own pocket, right, and invest $3,000 to $4,000 a month, or not a month, a year, instead of taking that and not like reinvesting it, paying taxes, whatever, investing in a growth position over the 10-year period, I think you'll do a lot better. And I'm not saying invest in something like TQQQ or something super speculative. I'm saying just focus on a decent, index fund like the S&P, the VTIs of the world, the total stock market index of the world. And I anticipate you'll do a lot better than if you were to invest in, say, a high yielding options ETF or something of the like, because those inherently are made for income and not growth of the portfolio. They're strategically going to limit the amount of growth in a single month because they are trying to write covered calls. That is the epitome of what the options ETF is there for. So I encourage everybody when they invest in an ETF or a stock to do their due diligence. And I really, really, really encourage folks to invest in any ETFs to read the prospectus. It's the first page, to understand the reason why that ETF was created. You could have ETFs made for low volatility. You could have people having ETFs for income, for high growth, speculative growth. And if you're just investing in them willy-nilly without the knowledge of any of this, you could be putting yourself at a disservice. So once again, I appreciate everyone's patience with the boxes in the background, the horrible green screen as always, and I hope this video was informative, and I hope to see you guys on the next one. Cheers.